I am Michael McKee of Bloomberg Television. I'm also the guy everybody out there is thinking, you're the guy standing between us and the drinks. So we'll try to make this as interesting as possible. While they're getting their microphones handed out, I'll point out that in order, we have Michael Drury, the chief economist at McVane Trading, Jeff Usher, head of research, Jeff Usher's Japan Insider, and Leland Miller, chief executive of the China Beige Book. Very distinguished panel, and boy, talk about specialties that are in the news right now. These guys know their business, and poor Mike Drury, not only is he an expert on China, but he works for a company that trades commodities. So this is not a particularly good time for him, but he'll have a lot to say, I'm sure. We had a very interesting presentation earlier today from Raphael Bostic talking about, in part, his impressions of the U.S. economy these days. But I want to get start with, this is an international panel, but you can't talk about the global economy without talking about the United States because it's the biggest economy by far in the world. So let me start with Mike because I know he's dying to talk about commodities in China, so I'm going to stick him with the United States. But first, just give us a general summary of where we are and what the outlook is for the U.S. because it looks like maybe we're at the peak of growth, but yet we have the tax cuts, but yet we have the tariffs, and it's kind of a confusing time for what the outlook is going to be for the rest of this year and maybe into 2019.
All right. We're going to put up pictures or not? I can do with or without pictures. It doesn't really matter. So I'm basically going to go through quickly how I get to my view of the world of where we are right now. And so the first slide just is going to show that we're at the peak of a manufacturing cycle in the United States. First chart. Do I get a clicker? So we're at the peak of a manufacturing cycle in the United States. You know, you can see that in the ISM numbers. And the key thing to notice there is that we're still on a 3-year manufacturing cycle in the United States. We're on very long cycles that are basically financial because we're more of a service economy now. But we still go through these short cycle manufacturing pieces, and we're kind of at the peak right now, and peaks don't last very long. So that's the first key thing to think about. Second is that we're now at the point where inflation or price increases, and I'm going to make a very big distinction between inflation and price increases. We're in the danger zone for price increases right now. And so that's going to be a very big part of the picture going forward. So the real issue right now is tariffs versus fiscal stimulus. I mean, we've seen the stock market sell off aggressively in the last couple of weeks because of the fear of tariffs. To us, this is no competition. You know, this is a chart that's used by my good friends at Strategas. I'm actually filling in for Don Rissmiller, who is supposed to be here talking about the U.S., who's the current chairman of the Global Interdependence Center. I'm the past chairman. The fiscal stimulus, you know, you've got about $200 to $300 billion in tax stimulus that was put on late last year in December, and then you got $150 to $200 billion of spending increases, mostly in defense, but then spread out in other industries like infrastructure, you know, for building the wall, for infrastructure, for the veterans, all of which is going to be spent and all of it's going to be spent domestically in the United States. So you have something like $500 billion worth of stimulus. Then you've got the repatriation. I still think most of the repatriation gets used in financial engineering as opposed to driving the real economy, but there's that too. And then the flip side is the tariffs. Well, the tariffs on aluminum and steel amounted to $500 million on the Chinese, and they answered with $500 million of their own. Now we're talking about putting a 25% tariff on $50 billion worth of goods, $12.5 billion. $12.5 billion, we have a $375 billion trade deficit with the Chinese. $12.5 billion is, I mean, it's not even worthy of discussion, but it's sold off the stock market by 10%. So that's what I'm looking at, is the power of that fiscal stimulus is going to drive the U.S. economy. Now, before we even started this year, we were going to grow about 2.2%. That came from about 1.5% productivity growth and 0.7% labor force growth. Then we got the tax stimulus. Well, the tax stimulus looked pretty good, and it looked like it was going to generate a lot of activity, and particularly in capital spending, and we'll get to that in a second. But there was a risk that they wouldn't spend the money, that they might use it for financial engineering, or they might use it outside the U.S., or they might use it for other things. Then we got the tax package. So the way I look at it is the spending package. The tax package was motive, and the defense spending in particular is opportunity, because they're going to spend that money, and industries that are connected to defense are going to have to spend. So the question now is going from that 2.2 up to, I would guess now, something like 3.5% for growth in the second half of this year. The question is, are we going to get the consumer sector and the rest of the business sector pigpiling on, and we get something even beyond that? And that's going to be a contest between these tariffs, the rising interest rates, and the fiscal stimulus. So domestically, you know, the small guys, the NFIB, are super excited. This is an interesting chart because it tells you that the NFIB right now is at a -2 for their Optimism rankings. In the entire history of the small business index, it's never been positive. The number of firms that say that they're going to make money has never been larger than the number that say they're going to lose money. And that just tells you that 70% of small businesses go out of business every year. But right now we're at a -2, I think, and it's the second highest that we've ever been. And part of that is driving capital spending, and capital spending's been going up over the last year and a half. Some of that's oil, but now we're starting to get the small businesses starting to add into that. And that's where one of the big optimisms about the growth in the United States is. And I think that is right. That is going to drive the U.S. economy. But I want to let you in on the dirty little secret that Donald Trump and nobody else wants to tell you about capital spending in the United States. 2/3 of the capital goods purchased by companies in the United States come from outside the United States. 60% of the capital goods produced in the United States are sold to someone outside the United States. That's why we've got a globalized economy. We specialize, they specialize. We use things that they make, they use things that we make. Now, a lot of this is American companies bringing their capital goods back in and them taking American capital goods and putting them out in China or elsewhere to equip plants. But there's this huge penetration. So the one thing I can guarantee you is going to happen this year is that the U.S. trade deficit is going to get bigger, and probably a whole lot bigger. And that's because everybody in America got a tax cut this year and will spend some part of that tax cut on imported goods, and nobody in the rest of the world got a tax cut, so they're not going to buy any more American goods. And so the tariff issues that we're talking about now are not going away, because even if the U.S. economy grows faster, the trade deficit's still going to get wider. Now, the other thing I like to look at is where is the consumer? Because if we're going to have this capital spending cycle, the consumer's got to be participating. The chart up there is to show the personal tax rate, the black line, and the FICA tax rate, the red line. Well, the first thing is the personal tax rate's fallen 3%. That's hardly the biggest tax cut in history. I mean, if you look at the Bush tax cuts a long time ago, I mean, this is a very small, the biggest tax cut in history was for corporations. It wasn't for individuals. For them, it was about 3%, which amounts to about 0.5% from 17 to 16.5 on that chart. But they are doing their part. They are spending. Adam Johnson was up here and he noted that the savings rate actually went up in January and February. That's because after the hurricanes in August, September last year, we had a huge amount of insurance payments go into Florida and into Texas. And that money was spent, and that drove the savings rate down. Now that the tax cuts are giving people even more money, the savings rates come back up, but it's still lower than it was pre-hurricane. So the consumer is doing their part. They're spending the money. A lot of people have been looking at retail sales recently and saying, oh, they're very soft. Well, they're very soft relative to the hurricane spending. But if you go back before the hurricanes, for the 6 months from now till then, retail sales are growing at 7%, which is a pretty toasty rate. And I doubt you're going to maintain that, but it tells you that the U.S. economy is moving well. So what's the biggest threat besides the tariffs? Well, it's inflation that would cause the Fed to raise rates and shut this cycle off. So inflation is driven by credit demand. It's not driven by wage increases. It's not driven by higher oil prices. It's not driven by any of those things. All of those are changes in relative prices of an underlying commodity, the price of labor, the price of oil. And what they do is they squeeze profit margins. And so the question is, when your profit margin gets squeezed, what do you do about it? Well, the idea here is, well, you just raise your price. Well, nobody can raise their price in America today. It's just not possible for most industries. So if we get price increases, if we get the prices of various goods going up and we get a profit margin squeeze, then the economic cycle will slow down. Where are we going to get inflation? If consumers go out and borrow more money, banks lend it to them, and they use it to purchase the same amount of goods, so you've got more money chasing the same amount of goods, then you get inflation. People are not borrowing the money. Consumer credit is not rising in the United States. It's not rising as fast as nominal GDP is in the United States. And part of the reason for that is that credit demand follows income growth by about a 10-month lag. And there's no income growth in the United States. You keep hearing this number of 2.5% wage growth in the United States. Now, I think that number will rise over the next 6 months to about 3%. So that means that the inflation, that the credit demand can rise maybe 0.5% as well. That's not going to generate a whole lot of inflation in the United States. So my story is tons of fiscal stimulus at the top of an economic cycle, which generates very rapid growth for a while. How long is the question? I don't think tariffs stop it. I don't think inflation stops it. I think it's the Fed that has to stop it. I think that you're going to have to see 4 rate hikes this year and 4 priced in for next year. They may never happen, but it will have to be priced in to stop the momentum that the fiscal stimulus is going to give you. How long does the stimulus last? The main thing to me is that right now I had expected more of a boom, but the tariffs are scaring people. And they're particularly scaring big multinational businesses in the United States. And what they're waiting for now is the midterms, because the midterms is a fork in the road. If Trump holds the House, we get one world. If Trump loses the House, and he's potentially impeachable for spitting on the sidewalk, then you have a different world. As big a fork in the road as you had between Hillary and Trump. That's 6 months away. Businesses are not going to bet on that outcome because they don't have to. So the stimulus that you might have got from the tax cuts probably going to be delayed until the result of the midterm is clearer. There are a bunch of people who believe there's going to be a wave election. There's a bunch of people who believe there's not going to be a wave election. I think the Republican primaries, where there are a large number of open seats, are going to tell you more about that process. But I don't think you're going to get heavy bets on capital spending until that picture is clearer. And I don't see that for 3 to 6, maybe the full 6 months, but probably not before then. So that's my story, and I'm sticking to it, and we'll let the others speak about the rest of the world.
Well, you talked a lot about inflation, and obviously somebody who would know something about prices and the history of trying to generate inflation, Jeff Huscher, we'll turn it over to you.
Thank you. I wanted to start to talk about Japan because a lot of people don't really, well, they've heard that the population is aging and the population is declining, and so Japan faces a real dilemma in terms of how do you grow your economy when your population is in decline. And so I thought I would try and address that and kind of give a sort of a 50,000-foot view of how Japan is trying to deal with this, because I think it's not only relevant for Japan today, which is already looking at a declining population, but virtually all of the countries of Western Europe, South Korea, and especially China are going to be facing this problem within 20 years. And frankly, the changes in population in China are going to happen so fast, Japan's going to look like a nursery school by comparison. So if you could put my slides up, please. Oh, yeah, there we go. Okay, so that's our dilemma. Do you have the clicker? Sorry. Thank you. All right, we'll move to the first, whoops. There we go. Move to the first slide. This graph shows Japan's population divided by major age groups from the first modern census in 1884, and it uses government projections out to 2115. And I just want to set the stage for what's really going to be happening here. Japan's population actually peaked in 2010. In 2010, there were 128 million Japanese. According to government projections in 2020, that population will decline by 3 million to 125 million, which is about the same as the population was in 1995. Move out to 2030, and the rate of decline accelerates dramatically. By 2030, you'll have only 119 million Japanese, about the same as in 1982. And if you go out to 2050, you're actually down to 101 million Japanese, which is about what you had in 1967. A lot of people joke when they look at the demographics and say in 732 years, Japanese will be extinct, but that probably won't happen. But if you take those projections all the way out, and these are actually the government's forecasts, they're not mine, you can see that by 2115, the population of Japan will have declined by more than half to about 50.5 million, or the same number of people as you had in 1895. So you've completely undone about a century of population growth. So just to put it into perspective, I like to throw this fact out. Between 2040 and 2075, you have what I like to call the great die-off. Japan will lose about 30% of its population in 35 years, and that's roughly equivalent to the impact of the Black Death in England during the 13th century. So this is something that's going to happen. It's baked in the cake. We're assuming no war, no Black Death, and that Japanese longevity will continue to rise towards 100. In fact, the government is making plans right now to support Japanese when their average lifespan is 100 years or more, and that is expected to happen relatively soon. So this sort of sets the stage. How do you grow an economy when the number of consumers is declining and declining rapidly? Whoops. I'll get the hang of this thing yet. Okay. One way you can do this is to make more of the people that you have. The population peaked, as I said, in 2010, but as of today, we still have 125 million Japanese, and we can make better use of them. There's a number of very deliberate government policies that are in place today that are actually changing the face of the workforce. The big picture here is that although the general population peaked in 2010, these are my estimates based on government numbers, the population of working people actually didn't peak until last year. And the reason for that is you have more older people in the labor force staying in the labor force for longer, and government has introduced a lot of policies specifically aimed at attracting women back into the labor force after they have children. So if you look at the composition of Japan's labor force from 1980, and I have projections out to 2030, you can see that the proportion of older people rises dramatically. You go from about 9% today to almost 13% of the total labor force by 2030. And the number of women rises fairly dramatically as well, going from about 40% to 44%, and it will probably sort of settle in right around there. So you definitely want to make more use of the people that you have. But that's not really enough. You still run into the problem of the fact that without consumers, you don't have consumption. It's the issue of how many pairs of socks can one person wear? How many bowls of rice can one person eat? If you have fewer people, there's less consumption. So what you need to do is import the people you need. Now, most people talk about importing foreign workers to keep Japanese factories moving, and they're sort of looking at Japan today as if it was Japan in 1980, where it was really export dependent. That's not the case. I think the real problem is consumption, and the Japanese government has come up with a very successful policy to support consumption. What they did is they reduced visa requirements for Chinese citizens back in 2015, and you can see in the chart that suddenly you see the big increase in tourist arrivals. Those are almost all Chinese citizens visiting Japan. So what you're doing is you're actually increasing you're importing consumers instead of workers. And that's what you need to do to keep the economy spinning. So in this chart, the bars are actually tourist arrivals, and the line is my estimate of the incremental increase in Japan's population on any given day from tourists. So right now, Japan's population is about 0.4% higher because of tourists. And if you go out to 2020, when Japan is supposed to host the Summer Olympics, on any given day, tourists will add about 0.6% to Japan's population. So again, you can see the incremental increase here is pretty large. One sort of illustration of how this is affecting Japanese companies is there was news probably a couple of weeks ago that two large Japanese paper companies have started to increase production of toilet paper for the first time in 30 years. And in each case, they cited the large increase in demand for high-quality toilet paper from visiting tourists. And, you know, again, everybody's got one, so you just need more toilet paper if you have more people. So this is another way that government policies have been put into place to import the people that they need, but it's not workers, it's consumers. What I think Japan is going to do in terms of production is to actually embrace technology. And I prepared a short video, if you could just run that for me. And, sorry. What we have here, this is from a industrial robot company, Fanuc. They're the largest robot maker in the world. And I wanted to highlight the green robot in the center of this page, because what that man is doing is he's actually teaching the robot what to do just by moving it around. And then I just thought that these picking and sorting robots were kind of cool. They can actually recognize shapes and colors. So that's where we're going with that to save labor. This is a Japanese commercial for unmanned store systems. And what they're doing is showing how you can put in these systems to allow the stores to operate without anybody being there. Can we keep that moving? There we go. So again, what you're seeing is, I guess what we missed in the thing here is that the woman approached a shelf for a product she had purchased before, and a digital price tag changed to lower the price because she had purchased that item in the past. This is another wacky Japanese invention for older people. It's a robot that washes your hair. It makes sense if you have a lot of old people. It does relieve caregivers of a lot of work, and our test pilot says it felt pretty good. And this last little thing is a robot that's called Robear, and what he does is he can actually lift people and move them around, which is obviously very heavy work, very labor intensive. So again, you make more out of your people by using technology. And you can see, just imagine lowering somebody even as small as that into a wheelchair by yourself. I mean, that's a recipe for a bad back. So this is where Japan is going to go from an investment opportunity. I think the development of these types of systems to deal with Japan's aging population, to deal with the rush or influx of Chinese tourists will create a lot of opportunities for equity investors in Japan. Thanks.
Well, the story of the world, in the world right now, is of course China. China, its growth rates, its ambitions, and where it goes in the world with the United States pretty much dominate the news these days. So we've got Leland Miller from the China Beige Book to tell us, in the words of my old friend Ed Koch, how they're doing.
Thanks, Mike. I think that there are two times where it's particularly fun to be a China watcher. The first is when you have a story that is completely different than what markets are seeing. And we saw that in 2013 before the big credit crunch that when Shibor rates blew out. We saw that in 2015, the summer, when markets thought that China was in free fall, that we were starting the hard landing, that there was a collapse scenario. And we saw that again in the beginning of 2016 when significant hits to growth metastasized into a potential currency crisis and a capital outflow crisis, and markets reacted very negatively again. The other time it's quite fun to be a China watcher is when you're seeing the same overall story as the rest of markets, but you very much disagree with why they're looking the way they do and what's going to happen next. Now, if you look at this chart, I won't go into a long spiel on the methodology. I think you should look at it directionally for now. But these are two of our proxy measures. By the way, my firm, the reason that we do is we survey thousands and thousands of firms every quarter for growth, for the labor market, for credit, for shadow credit, for inflation, et cetera. And we track a completely independent set of Chinese statistics, which are quite often different than the official story. Now, what's interesting here is that our story for the last 18 months to 2 years is not that different from the official story. You see, at the beginning of 2016 and of 2015, you took a hit to growth, and you've seen quite a remarkable recovery in the quarter since. And that recovery is real, and it's something that I think that very few people disagree with. The last quarter is up there. This is our recent data out from a couple days ago. You know, revenues continue to improve, revenue growth continue to improve a bit, profits weakened. So you have a fairly moderate story right now, but it's still a story of strength as we start the year. Now, here's where we diverge from the consensus narrative. I picked three of the most interesting to highlight. The first is inflation. So many of you probably saw over the last week or two that PIMCO and certain others firms came out with this idea that an inflation crisis is becoming more and more likely in China. And I think that what went into this reflects some of the worst tendencies in the China watching world, which is to take an anecdote here. You know, maybe there's a month of CPI jumping and some frothy steel prices, which we'll talk about in a second, and maybe a couple other data points and extrapolate a larger macro story. Well, here's the macro story that we see in our data, and it is certainly not of a China where inflationary pressures are bursting out of control, and it's not one where China is on the cusp of exporting inflation. So leaving again the methodology aside here, this tracks input costs, wage rate, input cost inflation, wage inflation, and sales price inflation in the economy. And what you could see here is that inflationary pressures peaked in second quarter 2017. The last 3 quarters, we've seen either steady or decelerating inflation in the quarters since. Now, this surprises some people because they hear all the time about all these commodity prices in China, which are going through this historic rally. And I think that's fair enough, but that thesis is also incorrect. So one of the major things that you read about, the Chinese are very, very intent on broadcasting, is their capacity cutting campaign. So the world has accused it of oversupply. President Trump has accused Beijing of the system that relies on oversupply. And the Chinese have said, no, we're taking care of that. We are making massive inroads into this situation. We're cutting down our steel capacity. We're cutting down our aluminum capacity. And they've published numbers that make it look like there's this enormous capacity cutting campaign going on that is going to right their economic model where it has gone wrong in the past. Well, here's what we're actually seeing. In commodities, and again, remember, commodities have fed into this idea that you've got stronger and stronger inflation in China and possibly leaving China. We have actually seen capacity in key metals, key commodities, go up every one of the last 8 quarters. So in steel, in aluminum, in copper, and in coal, we have seen firms continue to hike capacity on net. Now, you might be asking yourself, well, wait a second, I have looked at the media, I've seen pictures of firms going out of business, I've read stories about this, I've seen firms shut down. That's true. There are gross capacity cuts going on right now, and you've got seeing a lot of smaller firms, and you're seeing a lot of outdated capacity being shut down. That is true. But on net, firms are actually continue to hike capacity. Now, why is this a problem? Well, there was this historic rally that we've seen in China for the past year and a half, 2 years, has been premised on the idea that there was very strong demand, and as we saw by the first chart I put up there, we saw that demand. There was strong demand. It was a nice, firm Chinese recovery. But the other part of that is the idea that the Chinese were cutting supply so that there's a market rebalancing going on in China. And that market rebalancing was based on the fact that the Chinese are actually serious now about taking all their steel overcapacity and aluminum overcapacity and doing away with it. And as a result, the rally of the past year and a half, 2 years, has been traced to the idea that demand is good, supply is diminished, market's rebalancing, you've got a nice healthy rally. Now, what was actually happening is you did have the demand, but the other factor there was speculative capital, which was flowing in. China has something called the money ball, which we call the money ball. It's this big captive ball of capital that can't escape China because of the closed capital account and goes to chosen sectors. So maybe a few quarters it's in property, another few quarters it's in equities, it goes to the bond market, it goes to commodity futures. It's been in commodities for quite a long time right now. So what we're seeing right now is a false narrative being painted, even by very sophisticated commodity firms, who are seeing right now this idea that this commodities are being, the supply of commodities, key commodities in China are being diminished, and that's what has spurred this rally. As you can see, that's not happening. And this is why, if you've been reading about the surprises for what happened in steel, steel's surprising people because you were supposed to have less output in the first quarter. Everyone talked about winter curbs and shutdowns and Xi Jinping instituting a set of discipline that we've never seen before. But even government data just came out saying that output had increased yet again. And people jumped up and said, well, how could this be happening? Well, it's happening because they're still hiking capacity. Aluminum prices are falling. And I've talked to a lot of aluminum experts. We work with the Aluminum Association, and what they say is this is very shocking to us because there's supposed to be robust demand. And we know they're cutting capacity because the Chinese are saying they're cutting capacity. Well, what's happening here? Well, what's happening here is the supply has not been diminished. And it's going to create it's going to very much throw a lot of these narratives off. First, the inflation narrative, but also the overcapacity narrative, because what's happening is not what markets think is happening. This is the performance of these commodities in the first quarter, which showed weakness, which was not expected either. The last one is deleveraging. So if you read it all about the Chinese economy and you've followed it all, what's happening with Xi Jinping, then you are under the impression, or if you believe the Chinese, that there is a significant deleveraging campaign going on in China. And this is really important because perhaps the main reason that most Wall Street shops attributed an optimistic look at 2018 to China was that they said China had a fantastic 2017 performance, and it was able to do that despite the fact that Xi Jinping had really sort of smushed down, gotten his hands dirty, and put a deleveraging campaign at play in the Chinese economy, and they still had these wonderful results. Well, here's the problem with the idea of deleveraging. Deleveraging is a definitional problem. So people see what they want when they say China's deleveraging. The first thing they saw was better risk management at Chinese banks and in the Chinese system, so that must mean deleveraging. And then you saw what was a shadow product crackdown by the Chinese, so wealth management products, negotiable certificates of deposit, all kinds of other shadow credit products that were issued by banks and insurance companies. The Chinese did go to town on them, and they said, look, stop doing this. They have since bounced back. But you had a crackdown on these shadow credit products in the financial sector, and so people said, well, that's deleveraging. And now, the third definitions come out. We, like a lot of others, have seen rates rise. And so you're seeing tightening credit conditions. And so a lot of analysts out there are saying, well, tighter credit, that's deleveraging. Well, no, it isn't, unless it stops firms from borrowing. So what happened to firm borrowing? Firm borrowing stayed stable for the last quarter. It stayed actually higher in 2017, far higher than at the lows of 2016. So what you've seen during this discourse about the deleveraging Chinese economy has actually been firm borrowing staying at about the same levels, except when it spikes before the Party Congress last year and spiked earlier in 2016. So there is no deleveraging of any kind going on the corporate side in China right now. And again, the reason that this is so important is that a lot of people have said that they were surprised by China's 2017 performance because they were told deleveraging was going on. China had an admittedly strong performance in 2017, and yet they were able to handle the deleveraging wonderfully, which means if deleveraging happens in 2018, like so many people think, if global central banks continue to hike rates, then this shouldn't be a problem because the economy is resilient enough to deal with it. Well, the economy may or not be resilient enough to deal with it, but we have yet to see a test case from the past 2 years. So those are the three items I think are best worth highlighting.
All right, I'm going to ask a few questions so that I can earn my chocolate Bitcoin, and then we'll turn it over to you in the audience. Obviously, the story, Mike brought it up first, and everybody's got it on their mind. It's been in all the other panels, is what happens with the trade tariffs and what happens with China. So let me put it to you, Leland, first. What does China want here? As we try to game out how this happens, we have a pretty good idea of what Donald Trump is thinking, but what is Xi Jinping thinking?
Xi Jinping would like the problem to go away. So, it's sort of curious when markets react to the Chinese moves because everyone knew what the Chinese moves, at least up to this point, were going to be. So you had at the beginning President Trump announcing what are fairly modest tariffs. The headline number was modest. The fact that they diffused these tariffs over 1,000 products instead of taking out a subsector or a sector, they were fairly modest tariff program. The Chinese responded in kind, actually are a little bit tougher. But the Chinese want this to go away. They are hoping that President Trump will react to this and say, oh, that the Chinese are real and they're not going to back down. And while they will put some things on the table, they won't put other things. And if you want a victory, you'll play the game up to a certain point, and then we'll all wink at each other, and we'll go to the negotiating table, and we're going to reissue some of the same promises we've given you over the last 3 to 5 to 10 to 12 to 20 years. And then we'll add a few things to that, and then we'll make some really big shows of some firms making inroads into China, and then this will go away, and we can go about our business of growing and becoming a world superpower. Now, that's what China hopes will happen. And quite frankly, as much bombast as we've seen from the president so far, Beijing has no reason to think that that's not what's coming. Now, I actually think that's not what's coming. But if you look at what President Trump has signaled and how he's talked a big game and the reaction has been a lot less, it has lulled the Chinese, I think, into a sense of calm on this, that they will be able to weather this storm, and this is going to be more of a short-term problem than a long-term problem. And I think that's incorrect, but it's based on the evidence. It's a reasonable conclusion to come to.
Well, if this is a long-term problem, and if you're right, then, Mike Drury, do we sacrifice the soybean farmers of Iowa on the altar of trade protectionism? What happens?
Well, so I mean, obviously the Chinese reaction was targeted at, Florida for fruits, Iowa for soybeans and hogs, Michigan for automobiles. It was targeted specifically at swing states. There are two measures that Trump can use to determine how much trouble he's in. One is the stock market, and I think the Chinese piled on April 1st because they had the stock market in disarray, and if they could press that point and create more disarray, then Trump would back off faster. And the second is, his ratings in various polls. And I use the Rasmussen poll because it's a very pro-Republican poll, so it tends to be the most favorable to him. Today he's down to -11, but in the last 3 or 4 days he's been -5, which is about as high as he's ever been in the poll. So I don't think Trump is feeling any pressure that, that this needs to be solved quickly. It works for his base, and, the job losses, we're going to get a number tomorrow. If that number is above 175,000, and I think the whisper number is as high as 200,000, it's pretty hard to see that he's going to back down quickly on this. If you fight a trade war, every economist I know is against trade wars. But if you're going to fight a trade war, the risk is that one, you'll lose jobs, and two, you'll get higher inflation. We have plenty of jobs in the United States right now. We have a 4.1% unemployment rate, and we're below the inflation target. So if you're going to fight a trade war, this is the time to fight a trade war. I'm 100% against it, but if that's what you're going to do, there's less damage from doing it right now than there would be from doing it, after we go to the top of the cycle, we get on the backside.
The commodities traders in your firm probably don't like to hear that.
They're not very happy. I give them a macroeconomic picture, and they remind me very quickly that they live in a microeconomic world. Hog prices have fallen almost 20%. Soybean prices were down 10% before they rebounded yesterday. I mean, if you're a farmer in Ames, Iowa, who raises soybeans and feeds them to your hogs, they got you twice. The last thing you need is Chris Whalen getting the banks to raise interest rates on you on top of it. So, I mean, it's getting pretty tough in the ag world. And the way that we look at China is agriculture, autos, aircraft, and Apple. They can hit all four of those, and they can do a lot of damage. And Trump says that trade wars are easy to win. Well, we're going to find out, because I don't think the trade's going away, because I think there's enough momentum in the rest of the economy, and I think the trade deficit will be continuing to widen, that we're going to come back and revisit this problem again and again and again in a round of negotiations.
China's economy is obviously huge, but to the extent there is an Asian counterweight to China, it would be South Korea and Japan. The South Koreans managed to get themselves exempted from the steel and aluminum tariffs, but the Japanese did not, despite being extraordinarily close allies to the United States for many decades now. Prime Minister Abe is coming to Mar-a-Lago. He's going to play golf with the president, we understand, and presuming he loses diplomatically, does that get them out of this? I mean, where is Japan in all of this?
Well, the Japanese were absolutely freaked out by the idea that they didn't get exempted. It really, I think it took them by surprise. And that really explains why Prime Minister Abe is here. There's been already quite a lot of collateral damage in Japan from the U.S.-China moves. For example, one of the little stocks I like to look at is a company called Tokai Carbon, which makes cathodes that are used in electric arc furnaces for making steel, and that's a consumable. The more steel you make, the more cathodes you need. Well, that stock was down 16% yesterday because obviously one of their big customers is China, and China is going to be making less steel. And you're already seeing this spillover into the Japanese equity market, and steel companies in Japan have held up reasonably well because there's a lot of special demand inside Japan because of the Olympics in 2020, and there are a lot of construction redevelopment projects going on, especially in Tokyo, but also in other major cities that are keeping that demand up. But after we're done with the Olympics construction, which will probably be early next year, you're going to see demand crater unless something happens. So Prime Minister Abe is going to be here. He's going to play golf. He's going to say, hey, we're buying the F-35A, we're buying the F-35B, we're buying everything your military guys can make. Come on, cut us a break.
Well, let me ask Lee this. The Chinese obviously have a problem with the accuracy of the data that we get from them. What is happening in their economy if they're telling us they're deleveraging and they're telling us they're cutting back on overcapacity, but they're not doing that? What's going to happen to Chinese growth over the next year, and then how does that play into all this geopolitical tension?
Yeah, I think the major problem here is that there's two stories that are being told and they're in conflict, and yet no one's calling them out. And the first is that you've got Xi Jinping, the new president for life, who is the strong man who will roll over vested interests, who will ensure that reform and restructuring and rebalancing are all conducted over the coming years, because only he alone now has consolidated power and can do this. And you will have a continuing battle against against pollution. You'll have a battle against overcapacity. You'll have a battle against corruption. You'll have a continued deleveraging movement. You'll have a continuing rebalancing movement. But at the same time, everything in China looks great, and you're going to continue to have high levels of growth that won't be any different from what you've basically been seeing. Maybe a little slowdown, but basically no change in China. China's stable going forward. Now, that doesn't even logically make sense. Either China's going to conduct significant reforms and there's going to be a hit to growth and there's going to be some changes in the economy, or they're not going to do it and things are going to be higher and stable for longer, and then you're going to have more severe dislocations down the line. But in no scenario does a Xi Jinping walking in, continuing to break all the China, but everything stays honky-dory. Nowhere does that actually play out in reality. So I think people have to be prepared. I think the major risk here is that over the years from 2015, particularly 2015 and 2016, markets started to look at China as a risk. And they said, maybe they're good stewards of their economy, maybe they're not. But even the most talented economic magicians in the world are still going to have a difficult time restructuring that economy and dealing with all that debt, and then dealing with whatever geopolitical stuff comes their way, whether it's Trump tariffs or whether it's issues of the Japanese or the U.S. and the South China or East China Sea, whatever it might be. That's a very difficult job, and there's going to be some volatility. And I think the problem is that 2017's performance was so spectacular, and it has convinced people that the hard landing is over. I was at a conference about 2 months ago, and the keynote speaker said China's hard landing is done. The next 3 years are going to be beautiful growth. And I think it's convinced people that China is no longer a major risk factor, whereas I would argue that China is one of the central risk factors in the global economy, and that is not going to change in any way, shape, or form over the next several years.
Mike, do you agree with that? I know you spent a lot of time in China. Do you agree with that? And if so, how does that affect everything we've been talking about?
So I look at China as a roller coaster economy that goes through 3-year cycles. So it bottomed in 08, it bottomed in 12, it bottomed in 15, and it should be bottoming here in 18. I've been surprised by the strength in the economy at the beginning of the year, and I think that's largely us offloading growth to the rest of the world. But I tend to agree with Leland that, Xi Jinping just got in. His goal in life is to make sure that the economy is at the top in 2021, which is the centennial of the party. So the economy has to be strong in 2021. They won the 2022 Olympic Games, so they'll use the same strategy as Japan to toke it up into that. So he's got 12 to 18 months where he can take pain right now. And I think you're going to see, another round of crackdown on corruption, crackdown on anybody who managed to squeeze through the National Congress that he doesn't like. And, so I think a slowdown in China is one of the larger risks on the scenario right now. If China slows down, they take less imports from everybody, including the United States. Meanwhile, we take more of theirs. The trade deficit gets wider. The trade issues don't go away. I think we revisit this again and again.
There's a scary prospect out there for the world, and that is North Korea nuclearized. When they fire their test missiles, they fly them over Japan. And I would imagine the Japanese are not too happy about that. What are they saying there about the prospects for some sort of agreement that would ratchet back tensions?
Well, obviously, if you could cut tensions, that would be great for everybody. They're not happy about the missiles. Again, I don't know how many people are aware, but there's a long-standing issue of anywhere between 20 and several hundred Japanese citizens that have been kidnapped by North Korea over the last 30 years and taken away to train North Korean spies. This is a real thing, and it's a big outstanding issue. What it is, though, it's not only a political risk, but it's a political opportunity for Prime Minister Abe. He's facing some serious problems politically at home because of some ongoing scandals. But if President Trump and Kim Jong-un meet and Abe can participate in either four-way talks, or the Japanese have also proposed through unofficial channels two-way talks. If he can come home with either live Japanese abductees or dead ones, it doesn't matter, that will be a huge political feather in his cap, and it could save his chances for a third term as prime minister. Those are very much in doubt right now.
All right, let's open it up to questions from the audience. If you have a question, just raise your hand, and I'll give you the opportunity to ask this panel something. Anybody?
So one of the things that I focus on in this capital goods chart that I was talking about how most of our capital goods are exported. Well, they're exported for a simple reason. There's just better growth opportunities in Asia than there are in the United States. And now that we've dropped our tax rate from 36% to 21%, there's still better growth opportunities in Asia than there are in the United States. The tax rate in China is 15%. The tax rate in Indonesia is 12. I mean, you know, we dropped it, but we're still not below them. They have population growth. They are behind the curve in terms of income so that they can come to the developed world. So I think businesses over the intermediate to long term are going to continue to invest in that growing middle class as opposed to, you know, the declining middle class in the United States and Japan and Europe and maybe China.
Just one thing to add on this. In terms of China, one of the more sobering stories that we see in our data is actually the overhype of the Chinese consumer. Not that there's not going to be a strong drive of consumption from 1.4 billion people. But if you look at the data over the last 2 to 3 years, the retail sector in our data has quite underperformed time and time again. And I think one of the reasons that there's a divergence from public perceptions on this is that the public sees Alibaba. And they say Alibaba is a proxy for e-retail. E-retail means e-commerce. E-commerce means the retail sector, and the retail sector is the consumer. How could you not be having this thriving consumption wave coming out of China with all the factors, with all the Alibaba growth, et cetera? And I think one of the main factors in this is people overlook the idea that e-commerce is to some degree cannibalizing traditional retail. But the larger picture on this is it's very hard to get good broad proxies of the Chinese consumer, and what has been accepted as proxies like Alibaba have not been in line with what we're actually seeing in terms of the retail sector broadly or in terms of consumption patterns. So I think that's currently oversold right now, and it's a matter of some concern because, you know, we're seeing the services sector do okay, we're seeing manufacturing outperform, but the time and time again in our data, the retail sector data underperforms, and it's a major issue going forward.
So if I could just add one point from the Japanese perspective, if you remember my slide about tourist arrivals, those are all, well, mostly Chinese middle-class consumers, and the Japanese are cherry-picking them. Not only did they loosen visa requirements for Chinese in general, but if you can prove a certain level of wealth, you'll get a multiple entry tourist visa because they want you in there to buy Japanese stuff every couple of months. And nobody gets multiple entry tourist visas, not even us.
There's a gentleman behind Michael back over.
How would you handicap Abe's chances at a third term? And if not, who would the leading favorite be? And does that favorite fall in line with some of Abe's economic moves or no?
Yeah, right now I would say his chances are no more than 50-50, and there's no one in line to succeed him who will be as aggressive in trying to stimulate the economy. The big argument in Japan within the ruling party is, do we grow the economy and then fix Japan's massive debt problem, or do we fix the debt problem first? Now, Abe is very clearly in favor of growing the economy. In fact, he said you can't fix the debt problem without economic growth, but there's no one who could succeed him that would feel the same way. So I actually would be pretty negative on the outlook for the Japanese economy if Abe doesn't get a third term.
A couple more questions. Richard, did you have a question?
My question is about the U.S. military attitude towards Asia. I think you said that 12 years from today we'll begin the Black Death demographically in Japan. That doesn't sound like a terribly attractive ally to have, and perhaps China can bribe Taiwan with enough. I mean, are we kind of in the early stages of U.S. withdrawal from the Asian part of Pax Americana?
I'll start with Japan. I mean, Japan has always been seen as the unsinkable aircraft carrier for the U.S. Navy. And whether there's 120 million Japanese or 20 Japanese, it's still going to be there. So from that point of view, strategically, I think it's important.
One other point to add on this, I think the biggest risk factor is actually one you didn't mention. I think it's Korea. Now, the president does not have a very good relationship with President Moon of South Korea. I don't think he particularly likes the South Koreans. He certainly hasn't treated them very well in the Chorus free trade renegotiations. And he isn't particularly a fan of U.S. adventurism, U.S. presence abroad. And I think the real vulnerability here, and this is the situation that keeps me up at night, is that the president will go into a negotiation with North Korea with the ability or with the willingness to put on the table U.S. troops, not just in South Korea, but in terms of Asia more generally. And I think the major risk here is that this is something that would just have China jumping for hoops. It's not supported by the South Korean establishment, but young millennials in South Korea will probably support it. The North Koreans would love this. So the major problem is President Trump is willing to put on the table things that have been verboten to all past presidents. So I think that Korea is the linch point here, and I think that's the real worry.
We have time for one more question, and since this is an international panel, particularly of Asia experts, I'm going to call on a Scot from Canada, Martin Barnes.
Thank you. Mike, what's your outlook for the US dollar, given your overall economic view? And Leland, on the currency front, what are the prospects for the full convertibility of the Chinese currency?
So I don't think it's so much the dollar with my view as much as it's the euro and the yen with my view. I think the dollar weakened. That allowed the United States to do somewhat better. It started to, as labor markets tightened, it started to export growth to the rest of the world. And that brought the yen and the euro back up. And, we're about a 50% retracement now from the bottoms on those currencies. And it's starting to be painful for Europe in particular, and I think for Japan to a certain extent. And so I think the next leg is to go back the other way, that the dollar strengthens through this peak period. Now, the question for me is how long this peak period lasts. And that, again, I go back to this midterm because I would have thought it had been over almost by the end of this year if it weren't for the fact that the tariffs and the midterm stuff are going to delay it probably into mid-19. So late 19 starts looking very dodgy for the United States at this point. The Fed will have gone 3, 4, 5 times by then. Peaks don't last forever. Trees don't grow to the sky. So at some point, you've got to worry about where the U.S. is. Now, it's too early to figure out what the backside looks like when you don't even know what the peak's going to look like. And the peak could be spectacular.
We published a commentary about 2 years ago called "The Yuan is the Dollar Painted Red," and got a lot of people mad at us about this because there's a lot of excitement about renminbi globalization. But the reality is the Chinese are very happy to have a currency that is pegged to the stability of the dollar. Now, it has caused them problems, and during a dollar rally, particularly if we see a spectacular dollar rally, they're going to have some serious problems. But the idea that the Chinese want to take over as a reserve currency has always been oversold. The idea that they're willing to create liquid bond markets to absorb global capital and relinquish the control over their capital markets and et cetera in order to do so has always been oversold. This is not something on the Chinese list. And right now, I think that the other part of this equation is that there's so much talk about how the yuan is becoming more and more free, because haven't you heard it's being pegged against a basket now, not the dollar. It is not being pegged against a basket. It is still pegged against the dollar. The basket is a rhetorical device to allow the Chinese to move the currency around and make it look like there's if they think something's too strong, too weak, then they can play around and say it's because they're manipulated against the basket. So I think that the idea that there's this desire, forget what could happen if the Chinese wanted it, that there's even a desire by the Chinese to make their currency internationalized, it's not there yet. They want this stability while they conduct their reform and restructuring, and then down the line they're going to worry about their currency.
Jeff, we have to ask you to comment on the yen.
Okay, well, I don't know. My feeling is that the yen is pretty much range-bound. The Bank of Japan has implemented its yield curve control policy, which pegs 10-year rates at officially about 0%, but realistically it runs from negative 0.1% to positive 0.1%. There's no change in this. So no matter how much the Fed raises rates here, you're just going to see spreads widen between the yen and the US dollar. And that, of course, makes it much more attractive to Japanese investors. Someone commented earlier that, we start moving up towards 3%, and all of a sudden, 10-year rates start coming back down again. Well, that, my friends, is the Japanese, because they've got tons of money. They can't earn any kind of a yield on it, so they're very happy to be buying dollars and euro. And when you get up around 3%, hedging it out, you can still get a pretty decent return. So I think that that's going to have put a lid on the yen and keep it range bound.
I see Chris Whalen has come back in the room after limbering up his signing hand, so that must mean that we are done here. So a big round of thanks to Mike Drury, Jeff Usher, and Leland Miller.